Hey guys, so in today's video, I'm going to be teaching you a super simple day trading strategy that has near enough an 80% win rate. Now, I'm not going to give you any back-tested data or results. What I want you to do is take this strategy that I'm about to teach you, go and back-test it because you will see for yourself that it has an incredible win rate. And this will do two things. Number one, it will give you more than enough confidence to be able to take it into the live markets. And number two, it will solidify the idea of this trading strategy inside of your head, which will show you that all you simply need to do is follow the plan and you will be profitable. So let's jump straight into this. So there's two base components when it comes to this trading strategy. Number one, we're going to be identifying liquidity and waiting for it to get swept. So that is our overall direction of the market and our liquidity. Now, if you don't understand what liquidity is or how to spot it in the markets, go and watch my last upload. I break down exactly what liquidity is, how to find it, and how to add it into your trading strategy. Once we've got liquidity ticked off, our next step is to make sure we understand our entry confluence. So in this specific strategy, I'm going to be teaching you how to utilize a inverse fair value gap. So that is all we need. Higher time frame bias, liquidity, and our entry, which is going to be the inversion fair value gap. That's it. So for this example, I'm going to be breaking down this trade that I actually took today on US 30. So here we are on US 30 on the daily time frame. So first and foremost, can you guys spot where liquidity is? Now, I know I had it on the screen just a minute ago, so this is a little bit cheating from you guys. However, I want you to really look at it. Can you spot the liquidity? What are we looking for? Well, if you go back to the retail days when you were learning how to trade support and resistance and trend lines and X, Y, and Z, first and foremost, we can see that if we were to put a trend line, you would do something like this. So you would put a trend line there, right? And then you would go ahead and find your support and resistance levels. And then you could say, literally right here, we've got support and resistance. Right here, we've got resistance. Price came up, tapped into this resistance, dropped. Came back up, tapped into this resistance, dropped. So what that means is this is a key area where a lot of people are going to be trying to short from. Not only that, but this is also going to be a key area in the market where people will have their stop losses above. Everybody who shorted here will have their stop loss just above. Everyone who shorted here will have their stop loss just above. Not only that, but people will then also anticipate the other side of this trade. What they will think is that if the trade breaks above, they want to have buy stops right there on the opposite side so that they can get in at the breakout, right? So we're going to have breakout traders with their limit orders sat all the way up here, their stop orders. We're going to have the traders who shorted the market with their stop losses up here. And we're also going to have everybody else who's trying to short the market on this specific day because we had NFP earlier on. So we've got a bunch of reasons as to why we have liquidity above this area. We have all of these orders sitting up there. So we're kind of now building a narrative. We're building a picture of exactly what we're looking for. Now, if we also take a look at the direction of this market, what can we see? Well, relatively speaking, it's bearish, right? We're putting this lower low, lower high, lower low. Yes, we're creating bullish internal structure, but that's a story for another day. At the moment, we're just keeping it nice and simple. So we've got a bearish market. We've identified liquidity. Now, our next step is just to wait for the sweep of that liquidity. Like I said, simple, three components. Higher time frame bias, which we've identified as bearish. Number two, find where the liquidity is. Number three, wait for the liquidity to be swept, find the inversion fair value gap, take the entry. Sounds simple. However, in theory, it sounds simple. In the live markets, you're going to find it a little bit more difficult. This is why I tell you what you need to do is go and backtest. The more you backtest, the more confidence that you get, the more data that you collect, and the more times you get used to seeing this play out over and over again. So that when you come to the charts like this, instead of me having to tell you, oh, look, there's support and resistance in this area. Oh, look, we've failed to break above twice. Oh, look, there's trend line liquidity right there. Oh, look, equal highs, da, 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 da. Instead of me having to tell you all of that, you're going to come to this market, there's going to be nothing on the screen, and instantly what you're going to say to me is, wow, liquidity right there, bang. You're going to see it. As soon as we get a sweep of that liquidity, you're going to see, wow, look, an inversion fair value gap. But you won't understand this until you spend time in the market. Number one, we found out that we've got some liquidity right here. Perfect, right? Okay, what else can we see? Well, This high right here is actually considered to be our previous high, right? Because if we look at internal structure, if we drop down to the 4-hourly time frame, what we can see is that this was our last high, our higher high right here. Since then, price has not broken above it. We've now had a market structure shift to the downside, indicating that we flipped bearish on the 4-hourly. So therefore, we've now induced sellers into the market right here who would have entered maybe at an order block, maybe at a fair value gap, but we've induced sellers into the market by giving them a market structure shift to the downside. So we've got sellers in this market who have also got their stop losses just above. So we've got a key high with a bunch of liquidity above it, inducement of sellers into the market that are trying to short with their stop losses above, inducing even more liquidity into the market. Now, you tell me, if there's so much obvious money sitting in the market, isn't it highly likely that that is going to get stopped out before price rallies away? Because think about it logically. If you are walking down the street and you see a wallet with money in it, are you going to just walk past it? Are you going to leave it be? Or are you going to run, grab it and run the opposite way? Right? Think of it like that. So that is our liquidity that we are intending to sweep. But we've spoken a bunch about this liquidity scenario. Now, what we really need to do is understand the next component of this trading strategy, which is to wait for a sweep of that liquidity and then to look for our entry. Because we need all three components to be in alignment with each other in order to actually make this work. Because if even one component is not in alignment, it's not going to work. So we've identified our liquidity. What we're now going to do is we're going to drop down to the 1 minute time frame. And this is where we're actually going to wait for a sweep of that liquidity. Guys, just a quick one. If you are struggling with your trading and you're struggling with concepts such as liquidity, fair value gaps, order blocks, market structure, multi-time frame structure, if all of this just goes straight over your head, click that link down in the description to book a call with me and my team, where we're just going to audit where you are in your current trading journey to see how we can best help you get to that next level. We want to make sure that you can become that consistently profitable trader that you said you're going to become at the beginning of 2025. We're halfway through the year. Don't let it get to the end of the year and you're still stuck staring at the charts in confusion. Click that link down in the description and I'm going to see you on that call very, very soon. So let's play price on. And as you can see right there, what happens is price comes up and it clips that liquidity. We take out all of the orders. We've taken out the stop losses. We've induced the buyers into the market by turning on or clipping their buy stops, which means they've now been added into the market. So we've got more money flowing in. We've taken out all of the stop losses. So now what we really need to do is wait for an entry confirmation, which is our third component. Once we get this entry confirmation, we are ready to rock and roll. Now, what is an inversion fair value gap? Well, as you guys know, a fair value gap is simply just an area in price where it has moved way too fast for the prices to be balanced. So 1, 2, 3. The third candle's wick does not overlap the first candle's wick, giving us this gap in the market. Now, if you want to get technical and you want to find out again what a fair value gap is, go and watch the video on my channel I uploaded a few days ago. Talks in depth about what a fair value gap is, how to identify it, and what exactly is a fair value gap. Because there's a lot of different people that tell you a whole bunch of different things, but essentially within this area right here, inside of this candle, only buys were offered. For the markets to be balanced, we need both buys and sells. Every time you press buy, somebody will have to sell you. Every time you press sell, somebody will have to give you a buy, right? It's just the way the world works. It's just the way the markets work. However, in this specific area, only buys were offered, no sells, which means there was a gap that was left, which means the market is no longer in equilibrium. So essentially what us smart money traders will do is we will look for price to come back, close out this fair value gap, and then go in the pro trend direction. However, an inversion fair value gap is simply when price moves rapidly exactly the same way, creating a fair value gap. However, instead of respecting that fair value gap, what happens is we actually go and disrespect that fair value gap. So we don't tap into it and then rally away. we simply just blast straight through it. Now that disrespect of the fair value gap shows that the buyers are no longer in control, because the buyers were in control when they created this fair value gap. They pushed price so rapidly in one direction that price had no chance to be in equilibrium. Therefore, when it gets disrespected with such intent, with so much speed and volume, it shows that the buyers are no longer in control and the sellers have now stepped back into the market. So now that we understand what a fair value gap is, this is our third component. So once we get that, this is exactly what I'm looking for, and this is where I'm going to short the market. Once we disrespect that fair value gap, what I'm going to do is I'm going to mark out the fair value gap going in the up direction. I'm going to take my entry at the open right there, put my stop loss just above that high, and then you can simply either target a 1 to 1, a 1 to 2, a 1 to 3, or you can target key areas in the market, again, such as liquidity, right? So if we take a look right here, we've got equal lows. So that means this is an area that price will look to target, because everybody who got in right here at this big push to the upside will have their stop losses sat right below, which means, again, we've got more liquidity to the downside. So therefore, you can do something like this. However, what I like to do is trail my stop losses so I can squeeze as much out of the trade as possible. But now we've done all of the hard work. We've identified the three components: liquidity, buyers, entry criteria. Once we've done all of that, we're now simply going to sit back, wait for price to come back and tap us in as it does right there. And then price will just rally away, right? So that is exactly what we're looking for. Like I said, this is a trade that I actually took myself today. So here is how I actually managed the trade. Once we pushed to the downside and we had this break of structure right here, I then went break even, which means I have no more risk on the table. And I'm watching. What is order flow doing? We are very clearly respecting order flow. We had this fair value gap. We came back up, closed it. And then what are we about to do now? Again, do a break of structure. So now that I can see that it is being respected, again, we can see break of structure to the downside. Another fair value gap. And what happened? We've come back up. We've respected that fair value gap. And what are we about to do? We're going to push to the downside. Again, to do what? Give a break of structure. What have we done? Again, we've created a fair value gap. What are we going to do? Respect it. So you can also stack multiple entries as you're going down in this trade, because we've got the cleanest structure. As you can see, we're simply creating fair value gaps, respecting them, pushing to the downside. Coming back up into this fair value gap, respecting it, pushing to the downside, break of structure. Again, creating another fair value gap. Are we going to respect it? Are we going to continue to push to the downside? Who knows? So what I'm doing now is I'm actually trailing my stop losses, right? Because what you want to do is squeeze as much out of this trade as possible. Because we're respecting this order flow, we want to make sure that we're trailing our stop losses. We want to make sure that we are at prominent levels in the market. So this fair value gap was respected. Therefore, we know if we break above this fair value gap, that means we are now going to be invalidating that bearish trend. And we're going to be doing what happened up here. We're going to be inversing this fair value gap, right? So my stop loss is right there. So let's continue to see what price does. It respects that fair value gap. It gets close to disrespecting this fair value gap. However, we then push to the downside. And what happened? We hit this entire trade, and where did price go? It took out that liquidity. And again, we can see more liquidity that we've got down here. Price takes out that liquidity all the way to the downside. So all you have to do is understand the bias, understand where the liquidity is, understand your inversion fair value gaps. That's it. Once you have all three components, you're ready to go. And like I said, I would highly recommend that you go ahead and backtest this strategy, because the more you backtest, the easier it will be for you to pick up these things, such as order flow, such as figuring out what the liquidity is, such as figuring out what an inversion fair value gap is, figuring out how market structure moves. The more you backtest, the more confident you become. And the more confident you become, the more confidence you have in the live markets to execute without hesitating. You won't be scared of the trade going close to your stop loss, because you know you've seen the setup play out over and over again. You won't become greedy when the trade is close to your take profit, because you know once it hits your take profit, once it takes out key levels of liquidity, it's then going to revert. So you'll be happy to take your profits. All of these emotions that come with trading, you can literally get rid of them by just spending time in the market. So I hope you guys enjoyed this video and got some great value out of it. If you did, then please don't forget to leave a like, comment, and subscribe. But on that note, I'll catch you guys in the next video.